All right. Hey, folks. Welcome to Pro Trader Strategies. We're starting a new course here. My name's Eric Wilkinson. This is your options guide, cracking the code to trading options. So in this video, we're going to build from real life examples, simple concepts to real life examples. We're not going to start off with the real hard stuff. We're going to build up to that. So I'm going to try and make this more relatable to you folks. And that way you'll be able to remember this going forward and be able to implement these strategies into your portfolio without really having a whole lot of second guessing going on. You will be able to determine whether you want a long call possibly or a long call spread. We'll break that down as we go forward in this course here. But this first one, we're going to talk about that long call. I'm going to start off small, and then we'll build on these strategies as we go forward, and we'll build a little bit as we go along on the concepts as to why we would want to implement any one of these given strategies, particularly the long call. Right now, we've had a pullback. It might be a good time to start implementing this. When we see pullbacks, we can even make money with the long call. I'll show you how that all works out throughout this video. Yes, you do not have to necessarily be always directionally right when trading options. As long as you're following these guidelines that I talk about, we can turn those tables of probabilities in our favor and try and make some money off of it. All right. So first off, the long call, we're going to start simple. It's not that difficult, folks, once you've learned a little bit about some of the nuances around options. A lot of folks get scared off because they get involved in, say, for instance, a long call, but they aren't following these guidelines that traders from the floor knew intuitively. So I'm going to try and explain those things to you so that going forward, you know exactly when, where, and why you would be putting on a long call. And we're going to try and make it simple as we go along here. All right. So, folks, have you guys seen what housing prices have been doing lately? They've been going a little crazy, right? They've been jacking up. Just even this year, I think housing prices are up over 30%. That is due to inflation and volatility, folks. When there's a lot of volatility in the market, think about this. We have folks from the pandemic trying to get out of the cities and into the suburbs. That's been driving some of these prices higher across the board, and that's due to volatility. But a lot of folks just say, hey, you know what? It's easy. Buy, just like buying a house. You buy low, you sell high. You hear that all the time, but what does that mean? I don't even know what that means. Buy low, sell high. It doesn't make sense unless you're buying a stock at a penny, because it can't really go much lower than that. So you know you bought it low and you're going to probably be able to sell it higher. But at any given time on this chart, we could be looking at something where, is this the buy low? Are we buying low here? Is this the buy low? You know, you before it corrected, you could have even thought that was a bit of a buy low, all right? We don't really know exactly how low it will go, all right? So pricing on some stocks, when you're just buying a stock or you're just buying some of these other futures and things like that, what I want you guys to realize is folks always say this, and it's so easy. Just buy low and sell high. Except the fact is, nobody really knows what's low or what's high. All right. So the buy low, sell high mentality doesn't always work. And as a matter of fact, a lot of folks, will get into a place where we're thinking this is the buy low, right? We think this could be a correction and buy low. Get in before the rebound higher. But no, it bounces. And what happens? Are you selling high there because of this correction? Do you think you're in a downward momentum? It's because I've forgotten to, I don't know why I cannot get over remembering to share. Let's kick it back to the beginning since you can't see the charts. I appreciate that though. Thank you. All right. The long call here. Basically, with a long call, we're trying to make money on a directional positive move. Can we see it now? Everybody? You guys seeing the screens now? I think so. And we're going to try and keep it simple, right? X's and O's is about as simple as it can get. That's why folks program with that, because it is the leanest you can get. And that's exactly what we're trying to get to. We're trying to streamline your process in order to find the optimal option strategy for any given assumption. So what we've seen from the housing market, the prices are jacking up across the board, right? This is in 1 year we've seen this type of move, and that is due to volatility. Some folks might say inflation, but I'm saying it's volatility. Why? Because volatility is the thing that is going to be making prices move higher and lower. You can remember, if we go back in time, right? We remember a housing crisis where we saw houses go south in price, right? That was due to volatility as well. Not necessarily positive volatility, but it was mostly because people were selling with both hands. And what I'm trying to get at with this is, even with a house, you could think that this is the buy low and the sell high, but the market does have a tendency to start rolling over sometimes. So is this the buy low and sell high? I don't know, because nobody, unless you bought it for a penny, really understands how low it can go. You can't go much lower than a penny. So what I was saying there is, that's about the only time you can buy low and sell high. If something's trading around $100, is that low? You might hear on TV from the talking heads, yeah, this is an opportunity to buy this stock cheap because the multiple is only 20, which is still a massive multiple, guys. So there is a multiple there that is adding in future earnings and things like that. So that's priced in already. But once that starts pulling out and you get that multiple to pull back, then the market starts rolling over, all right, due to some of that volatility, especially like what we're seeing recently. So a lot of folks might wait for the pullback there and think that they are getting in on the buy low, right? You missed this move here. Market starts rolling over. You're thinking, oh, we got to bounce. We're going to take off. This is the buy low. And then you go through this. It's gone all the way back down to basically where it IPO'd, does a little bit of a bounce. It's not quite gotten back up to where you wanted it. And all of a sudden, bang, retest, comes up here. We start looking like we're rolling over. What would people do? Well, most likely panic, and they'll get out. So thinking they sold on that bounce, well, and then you get a rebound. All right. So all I'm trying to do is talk about pricing. You can, even if you buy it for a penny, you can still lose 100% of your money. That's right. You are absolutely right. I love statistics. That's a great one. So the fact of the matter is, it's very difficult when you're looking at a stock or an ETF or even an asset like gold or silver, even down to corn. It's hard to tell what is low because the market can act irrational as well. But one thing we do know is that when we're looking at options, we get a little bit of a tell that the pricing is cheap. All right. I'm not talking about the stock is cheap, folks. What I'm talking about is the option prices are cheap, meaning what I have to transact, buying and selling those options. I know the prices can be cheap when we get a tell. And that's what we want to look for. Anytime we are looking to buy options, right? You don't want to pay inflated prices. You want to be able to buy it when it's super cheap, right? And the only way to know this is to look for volatility in the market. And this is what volatility looks like. It stays within a pretty tight range, but we can see when it gets at elevated levels or a resistance area, or it finds support. And every individual stock has its own range, okay, for volatility. Tesla's volatility is through the roof compared to like a utility, okay? So you can't really compare necessarily tech sector to utilities when you're looking at IV. You could be looking at Tesla and saying, we're used to trading this utility, and think, okay, well, like 30 volatility is pretty good. And then you look over at Tesla and 130 might be really low. Okay, so don't look across and compare apples to oranges. If you're comparing volatility, you can only compare the volatility for that underlying. Okay, that makes sense? We need to narrow that down. And Thinkorswim actually does a really good job of displaying this. They have a chart that you can pull up at the bottom, and it's called implied volatility. So when we're talking as traders about volatility, we are talking specifically about implied volatility. All right. I'm not talking about the VIX. The VIX gives an overall arching statistic or data point that tells us where the overall market is feeling for volatility. All right. And each individual underlying will have something like this, where it will stay in a range. So for instance, this particular underlying that I was looking at here, the volatility at a high level is 0.35, or what we would say is 35%. So you can see that that would be a relatively high level. And then when it gets really low, it's down in around the 15s or in the teens. Okay. So with this chart, what we want to do is really kind of come up with a defining line between a mid-mark, like a 50% halfway, because up here you would want to be selling options because volatility is high, and down here you would want to buy options because we know they're cheap. All right, we know they're cheap when this line is way down here, because it's every time it gets down here it starts going higher. All right, so when you're buying options, kind of get that line of delineation about 50%. And above that line, you want to be thinking option strategies that I need to collect a credit because their premiums are so expensive. And the other flip side of the coin is when the volatility is way down in here, we know it's at some of the lowest levels. And therefore, we know the prices for that underlying over in the options are super cheap. Okay. You'll be able to tell across the board whether they're, I'm talking like 8 days to expiration all the way out to 700 days to expiration. Those options are cheap. Now you might look at like 8 days to expiration and 700 days to expiration and say those 700 days to expiration are really expensive. Well, yes, because you're paying for time to be right. But in theory, as volatility fluctuates, as volatility is increasing, price of the options, price is increasing also. All right. And I'm going to show you that when we get into the real life examples, but simple concepts. Know that when volatility increases, prices in the options are increasing. XYZ stock, this XYZ stock, let's just say, it probably has moved zero in either direction. Okay. We could say it hasn't moved a dollar during this time, and if volatility increases, I know that the price over in the options are increasing, even with this underlying not moving. And when the volatility rolls over and starts coming down, I know that the price of those options is coming down, even if the underlying never moves. Okay? Everybody with me so far? I'm talking about how this volatility affects options premium. Options premium. All right. So volatility drives price. Now, we can see that for every 1 percentage point increase, volatility increases by 1 percentage point across the board in the options. If volatility or implied volatility, it's just shortened, implied vol is what I'm going to call it, increases by 1 percentage point or decreases, then my premiums are going to be affected by the volatility coefficient. All right. Meaning if my volatility coefficient, when we get in there, is like 6 cents, that means if volatility just increases by 1 percentage point, all of those premiums will increase buy that 6 cents. All right. All those options that are associated to a 6 cent volatility. All right. Now let's take a real life example here real quick. Looking at Disney. Now, Disney and all the streaming, I think, is going to start really taking over. Who is going to win? Well, there's Disney, and now we've heard Paramount. They've combined CBS and Paramount, and they're going to go under the flagship name Paramount. We know that. Those guys are doing very well. I think Disney really has the stronghold in this sector. They have the portfolio of all of the movies. They also have TV and the theme parks and all of the other stuff that goes along with the theme parks, all the souvenirs and not souvenirs, not really, the trinkets that you can buy for the kids, Snoopy ears at the store or whatever. But what I'm looking at here for Disney, I'm bullish. Volatility is really low, right? We can see where volatility is right now, 33. You can see that 33 would be pretty high for that last example I had. That's why I'm saying don't compare apples to oranges, because this low here might be only around 25. Okay. And you can see the high is up around 50, right? Just recently had that, but volatility came out and now we're looking at pretty cheap prices. Can they get cheaper? Yes. But folks, all we're trying to do is turn the tables of probabilities in our favor. Volatility can go below this 25 for Disney. It could go down to 20. I mean, it could be a historical low, which would be, a little bit outside the realm, but it could happen. All we're trying to do is capture, hey, we are at a really low level. And for folks that are newer to trading, you could even break this down into like thirds and say, below this 33%, area, I am going to be a buyer. In between this, on this 33%, you're basically, you're not doing anything. I would say you're a hold, at least for this strategy. That we do have other strategies for it. And then, up here, this is a sell at that 33 percentile, upper range. So if you're newer to trading, you want to make sure that you're getting in that super expensive when you're selling and super cheap when you're buying, then kind of peel it back just a little bit more. Higher risk tolerance, just kind of look at that 50-50 break below and above. That's what we would look for. So buying when volatility is below in that lower extremity, or selling when it's in the upper extremity there. All right. We're specifically talking about this underlying being at an extreme low level. So I'm going to look to buy an option strategy. Now, if I was bearish, I would not be buying a call, right? So I'm bullish in this underlying, believing the market's going to start moving back towards the point of control. But all else, I believe that we're going to cover this little gap. That gap, I think, is going to get covered. So we're looking at between 165, 170 is that mark. And then I'm hoping for 175 to get up to there. So those are kind of like my lines in the sand there. What third are you talking about? So like we broke this out into thirds this way. This would be a sell up here, buy down here. And, you basically have your neutral strategies. And I have a lot of neutral strategies where we can counteract some of these things that I'm gonna hold off on some of those more technical ideas as we go along. So, but I see a few faces that I recognize that are totally probably catching what I'm dropping right now. So buy zone in that lower third, and we can see we're down in that lower third there. Sorry. All right. Let's simplify these options. Now, my next page could get a little overwhelming. It feels like you're looking at the inside of an airplane cockpit, but I'm going to try and narrow this down for you. Let's simplify options. Delta, there it is. I couldn't hold off. No, just kidding. Let me do this first. Let's look at Delta. Delta tells us a lot of things. All right. Delta, there's the symbol for it, is just change. And it kind of gives us a bit of the rate of change to our premiums. Now, so for instance, if a delta is 50, that means for every dollar the underlying moves higher, then the premiums increase by 50 cents, okay? Just like if you buy 100 of the underlying and it moves higher by $1, what's your delta? Can anybody throw it over there on the side? No, nobody's going to jump on that. If it moves higher by $1, our premiums increase by 50 cents. The other thing that delta tells us is the probabilities, the percent of in the money, the probability of being in the money at expiration. That's by a penny, folks. It tells us what your probability of that strike being in the money is. That's right. Mark got it. The delta, if you bought 100 of an underlying, is 100. For every dollar move higher, that underlying will, that every dollar that underlying moves higher, the premiums will increase. Your profit will increase by that $1, right? So that's 100 deltas. 50 deltas in the options means if the underlying moves higher by $1, my delta is 50, my premiums increase by 50 cents. So my overall profit increases by 50 cents there. If you buy 100 of the underlying, your delta is 100 because for every dollar move, your position is affected by that dollar, okay? Percent in the money, let's just stick with a 50 delta. That means it's a 50-50 chance of being in the money at expiration by 1 penny. But something we have as a floor trader hack, the hack is 2 times the delta equals your probability of touch. This is what we used to say on the floor. Meaning during the life of this option, your delta tells you the probability of in the money by 1 penny, but during that life, anytime during that life of that option, 2 times the delta gives you your probability of touch, meaning the underlying will come up and hit your strike and then maybe rebound or sell off if you had a different strategy on. But the idea is that it will come up and kiss you twice as often as it will settle in the money. So your probabilities, you want to smack those, especially on a long call when you get hit on it, all right? Maybe peel off a couple. So probability, 2 times the delta is the probability of touch. Now, gamma just goes with delta, all right? This was dollar. Delta talks about that 50 cents for that first dollar move. Gamma adds in on dollar number 2. So if like gamma is 6 cents, that second dollar higher, my premiums will increase by 56 cents. Okay? So gamma goes with delta on that second dollar. And then we go to theta. Theta is the thief. Theta is the thief in the night that comes and steals your premium. It's always negative. You cannot ever go back in time. So theta is always negative. All right. It's always going to erode your premiums, folks. Tomorrow you wake up, even if the underlying hasn't moved, you will see that theta coefficient come out of your premiums. And then finally, we got Vega. And Vega is actually the only one that is not a Greek. All right. A Greek letter, a real Greek letter. It is implied volatility. All right. So if you ever see Vega, know that it's just implied volatility and they just came up with a really cheeky name for it over there in the option montage. All right. Why? That's maybe because they didn't want to write out implied volatility. Probably. So they came up with Vega. Vega basically talks about increases or decreases by 1 percentage point. All right. So let's go over to the option montage. What happened there? I don't know why that stayed. Anyway. All right. So back to the option montage. We have our calls and our puts, right? And we can see delta, we got gamma, we got theta, we got vega, all right? Same over on the put side. I'm going to stick to talking about the call side for the most part, all right? Because that's the option strategy we're going to use. And I'm going to erase this just because I'm going to talk about that as well. All right. So delta, what we were talking about, if this stock, Disney, increases by $1, we get $1 increase, right? So now we're at 155. Well, then this option, these 155 calls, 46 cents will go into that premium. So from 221 to 267, right, on the bid. And then on that second dollar, we talked about second dollar move, if we had one, then this gamma goes with delta on the second dollar move. So then we get 56 cents would then go into those premiums on the second dollar move. All right, so gamma goes with delta on that second dollar move. So you can start seeing how gamma starts increasing or decreasing based on the ebbs and flows of the markets here. And then theta, that thief in the night I talked about, is always negative. You can see it's always negative across the board. But one thing you will notice is theta is less aggressive out in time out here than it is with only a couple days to go, right? So put your thinking cap on just for a second. If I am buying options because that volatility is really low, I know volatility is super cheap because we saw it over there at the chart, right? And being that these premiums are super cheap, I'm leaning towards buying, right? Because I know they're cheap. I don't want to sell something that's super cheap. And I know that there's a pretty defined volatility coefficient there where we can see the upper band and the lower band, and it's been doing that for the last year. So why wouldn't it do that again going forward? That's how these work. They do have a tendency to stay within a pretty tight range for these guys. So theta is negative, more aggressive. The closer you get to expiration, further out in time, a little bit less aggressive, right? Now, I'm not necessarily suggesting going out 148 days. I don't hold on to trades, generally speaking, longer than that. I'm usually in and out within maybe a month or two. So the longest I usually will kind of hold on to a trade is a couple of months. So I usually, for buying options, I like to get out here somewhere between 70 and 100 days, let's say, is really my buying area, is where I'd like to go. Because as you can see, between 56 days, you go in 30 days, actually go in 30 days, you can see that that volatility really started ramping up. And then if you're inside that 35 days, you can see that really almost doubles within the next 20 days. So can see that it's not like binary, or it's not even where he takes a penny, a penny, a penny, a penny. He really ramps up the closer and closer to expiration, because he's got to think he's got to get to zero by expiration. Okay, so that's why that thinking, anything that's out of the money, any time decay, which is theta also, theta is time decay, it has to all be gone by the end of all of this. So yes, these are more expensive premiums out here in time, but that's because you're buying time, all right? So they are more expensive. They're still cheap relative to what this underlying has seen for the options at any given time, okay? Does that make sense for everybody? So if I'm buying options, I want to be out here. And when I want to sell options, I want to be inside of less than basically 45 days to expiration. That's your sell zone. Because that theta can help you out. Like I said, turn the tables in your favor, folks. Try and limit your exposure to theta when you're buying by getting further out in time. Yes, you do have to pay a little bit more. You're going to have to put up more money at the onset, but that also is giving you a lot more time to be right, okay? Because strategies don't always just immediately work out. okay? So try and get out here for your buy zone. And the last thing I want to talk about is Vega. Now, I talked about an increase of 1 percentage point. We could see 9 cents would go in there. Now, Vega moves at more than an increment of 1. It has a tendency to move at, 1, 5, or 10 kind of thing for these underlyings, depending on what underlying you're in. Tech sectors will definitely juke a lot more. So 9 cents would go in there. You can see further out in time, volatility affects your options a little bit more as well, right? So volatility affects the further duration options more so than the nearer duration options. Another reason why I like to get in when I'm buying those options further out in time, gives me more time to get that volatility to start jacking up. You could also, since we know that options have a tendency to increase, I don't know why it's doing that today. Somehow I got it the ink to stay, but not the, I wanted this chart. The volatility here with the underlying, now I lost my train of thought on volatility on this coefficient here. I don't know. All right, so if volatility increases by 1 percentage point, just to make sure I've covered this to nauseam, I guess. If we increase by 1 percentage point, all right, so basically we're looking at 32.24, exactly 1 percentage point. So 9 cents here would jump into those premiums there. We would have like 17 jump into that premium, okay? So it is going to hit the premium correlated to that option. For instance, that one would go with that one, right? All right, so over here on the call side, boom, goes in there for the 1 percentage point. So this is where I'm talking about. You can get a 5 percentage point move. You may not think that 9 cents is a big deal, but when you do it at 40 cents, because it's a 5 cent move or 45 cents, that makes some moves. All right, 50 cents jumping into your premium overnight because you just got some volatility. Now, another thing with volatility really quickly is volatility will affect the further duration options more so than the nearer duration options. When we're buying those options out there, we know we're getting them cheap. We want to see that increase. Now, a lot of times when the underlying decreases in value, that's usually when we see vol increase. You see the VIX increase. That's the broader gauge of the overall market. You see that increase because people are buying puts and buying protection. They're driving price higher, and sometimes they just aren't really thinking clearly. They're just thinking panic and buy to protect myself. And a lot of times when we see that buying frenzy happen, the calls get jacked up as well. And we've seen that time and time again. When markets really pull back, even the calls are affected positively by the increase in volatility. All right. So you can make money on options when they're falling down, even on the call side, right? Call options. You can make money on the call options on that volatility jacking up. You could think about it this way. If this underlying dropped by $2 today, right? And we're looking at these 55s. So $1, because we came out down $2. We came out $2. So 2 times this 50 cents, $1 came out of these premiums. Now, if this underlying had that volatility and that sell-off increase by, let's say, 10 percentage points or something, 10 percentage points, 10 times that, it would have offset most of that directional move, okay? It went down $2. I lost $1 out of my options, but my volatility, actually, here's the volatility. Sorry, I was looking at the wrong one. Volatility, I knew that was too low. So 5 times this 24 cents, I'd get about $1.20, right? So in that case, 5 percentage points increase in volatility would offset basically a $2 move. Does that make sense? So if we were looking at our option montage, we did see a little bit of an uptick in volatility today in Disney. So let's just take a look and see if I can find Disney on a chart. I'll pull up a chart. So Disney did get an increase in volatility. Let's say it went from 31 to 33. So it got 2 percentage points increase. All right. So 50 cents went into those premiums on the call side, even with this market rolling over. All right. See how that works? Does that make sense? Volatility increased, offsetting some of the incorrect directional move that happened for folks today. Okay. So a lot of times people don't understand why they're making money in options or losing money. Sometimes they're buying calls and like, hey, I'm directionally right on this. The market has come up almost all the way to my calls and I'm losing money. How does that happen? Well, it's probably because in the slow grind directional move there, volatility really came out and offset all of those moves to the upside on something like that. So make sure when you're buying, you're getting in when volatility is extremely low here, especially with just the long call. All right. So breaking it down, let's talk about the strikes I like to look at personally for being a long call, and I'll talk about why. I like to go, like I said, somewhere between 70 and 100 days out, because the theta is right there. You know, I don't want to pay twice as much for these options to get 50 more days necessarily. So I'm not going to plan on being in it for 100 and some odd days. So I'm going to look at 92 days. We know that this is too close to that sell zone for options. So I want to stay away from that. And because of the theta that's going to start in, theta is going to really start increasing there. So between these next 40 some days, I'm only going to lose an extra penny. All right. Whereas from these 30 days to like 25 days, I'm probably going to see theta double. Okay. So limit that theta increase. All right. So I like to look at right around that 36 delta, somewhere right around there. I got the 35 delta, somewhere between in the 30s, 34, 35, 36 is really what I like to look for. The reason why is, remember, 2 times the delta. All I'm looking for is the underlying to come up there. Remember my thesis on this, come up, cover that gap. Well, if that happens, the markets come up, smacked my underlying, I know I've beaten the probabilities, right? The probabilities of being in the money at expiration are 35% because that's what delta tells me, right? But 2 times the delta is the probability of touch. So if I can beat the probabilities by getting that move and hitting my strike, then I'm good with that, all right? I like to pick the strike where I'm looking for that as the target. All right. A lot of folks will say, oh, dude, Wolfman, everybody says you should go for these 84 delta in the money options because you don't have a whole lot of theta decay. You don't have to worry about it, blah, blah, blah. Listen, you don't have to worry about a lot of theta decay, folks. You probably have to worry about as much theta decay as I do on my strategy. Yes, my strategy can go to 0, but so can this one that's in the money. If I'm directionally wrong, I have a whole lot more money to lose on that one that's in the money that all these folks, these talking heads talk about. Listen, floor traders never bought in the money options. It doesn't make sense. You can lose too much money. Yeah, your probabilities of being in the money are pretty darn good, but that's the probabilities of being in the money by 1 penny. All right? An 80 delta tells you have an 80% probability of being in the money by 1 penny. That means you're going to lose almost everything, right? Whereas I might lose everything if that still happens too, but I didn't risk as much, right? So that's why I go for the out of the money, because if I'm directionally wrong, which I am, I mean, who's not directionally wrong? Probably more often than not, right? So if I'm going to be directionally wrong 50% of the time, let's say, then I don't want to risk that kind of cash. It's not going to make up for my being out of the money, all right? My being out of the money will actually increase as a multiple, right? I could have 100% increase in this one versus, statistics, right? When we go back to those fun statistics, we will see percentage point increases that are better here, if you want to look at that. But it's definitely better to go to those out of the monies across the board. If you watch any of my other videos, I have all kinds of videos where I really drill into this. It takes a lot of time though. So we'll skip that. So 2 times the probability. So I've got a 70% chance of in the next 100 days or 90 days that my underlying is going to trade all the way up to 165. I'm going to see 165s trading. Okay. And I want it to come up and cover this gap. So my target for this, looking at the 65s, cover that gap. If we hit this mark right here, it's going to try and cover that gap for sure. And that will put me in the money. All right. And a nice little increase. All right. Let's do a quick review here. First off, what's the most important? Greek. There's your quote. There's your clue. What's the most important Greek? Yes. Vega. As far as I'm concerned. Why is Vega the most important Greek? Because it's the one that's not really consistent. We can look at Theta and see Theta's, all right, Theta's, oh, yep, Theta's getting really, right? We can do that. We can say Gamma goes with Delta on the second dollar. That's obvious. We know what Delta does to the premiums. We've talked about the probabilities to nauseam. But Vega can really cause turmoil to our psyche because Vega can adjust the premiums and we're not understanding. We could be, if I'm thinking I've got a directional move higher, right? And let's just say I sold some puts or something and volatility starts increasing, well, then my premiums would increase. And I would be like, I've sold puts and I've got this directional move, right? But my puts are increasing in value. Well, it could be because there's an event around the corner that is driving volatility as folks are, yes, manage the risk. As folks are buying options, it can happen to calls as well. You start seeing a big move, people come in and buy calls. It drives up the volatility across the board. The puts start increasing in value. Okay. So Vega, if Vega starts going down, if Vega goes down during this move, we're going to see our premiums decrease or at least not increase as much as we would expect. So make sure that if you're ever looking to buy those options, we need that volatility to be low, because if I bought a call and the underlying sold off and vol went higher, then these could be, like the star of the show. And it's happened. I'm telling you, folks, I've seen it happen quite often where the market will start juking. Probably like today, we could have probably seen some folks be talking at the bar at happy hour today saying, yeah, I made money today buying calls in a down market. It happens. So bottom line is Vega is the most important. We want to buy low. So when you're thinking of options and buying options, you buy low in volatility and you sell volatility high. All right. When you're trading options, you come up with your directional assumption. You come up with your support or your resistance to come up with this directional move. The first thing you have to be thinking is, where is volatility? Nothing else matters at that point. You have your directional assumption, but nothing should matter to you at this point until you find out what Vega is. You don't have a clue whether, if you have a bullish move, you're buying a call or selling a put. The only way to know if you're going to buy a call or sell a put for a bullish directional assumption is knowing where Vega is. in and of itself. Compare apples to apples. We have to look at this underlying and compare apples to apples. Because we want to limit theta decay. We want to limit theta, the thief. Theta. All of a sudden, I can't remember how to spell theta. All right. Theta, the thief. We want to limit. Whoops. We want to limit theta and be around 90-ish days. I like to say 70 to 100, really. We're looking at that 92 days right now. So that's the star that we're looking at, right? So we're trying to limit that erosion of our premium because we're buying and we have that low volatility. We immediately know when we have low volatility, we want to limit the thief, right? And then the next thing we want to look at is delta, and stay away from the in the monies. I don't care how much risk tolerance you have. I've done the math over 25 years and I've really never seen it work out consistently that if you bought the in the money options and were directionally right, that you were able to make more money, right? If you bought it in the money option that was like $20, your option might increase by $10, but it only increased by 50%. My out of the money options I bought for $1 might increase to $10. And I've increased my profit by 100%, right? But my risk reward on the in the monies is $20 worth 10. And my other one is basically, like $5. I know I'm going to risk, and I could gain $5 if I got up there to hit my strike. Okay. Well, in the money options are only going to retain their value, meaning an in the money option, if I'm looking at, let's say the XYZ is trading 100, okay? And I'm long calls at the 95 strike, right? So my calls are in the money. Now, right now, we could be looking at these premiums being right around $6, okay? Now, what happens if this underlying has $0 moves up or down $0, right? Well, this option is only worth $5. So I would lose that whole dollar if the underlying didn't move. There's theta decay in there. It will retain $5 because I have to be compensated for the difference between 95. That $5 plus the 95 equals 100. So it has to at least, in the money options, has to at least be equivalent to the difference to where the underlying is. Okay. So those in the money options, a lot of folks will say, well, you'll hold on to your money. Well, yes, you will if you're directionally right and the theta all erodes out. You'll keep that what its value is. But if it came back down, then you lose all of it. I lose all mine too, but I didn't risk nearly as much. All right. So Vega, understand Vega. That's how you crack the code to trading options. Understanding Vega, because you immediately know if you have a bullish directional assumption, I look at Vega. That is then going to open the door to either buying options or open the door to selling options, right? Immediately. And then I start building on what I'm going to work on for my strategy based on my directional assumption. Okay. All right. Something I forgot to say, if you had a light bulb moment, please smash that like button for me. It does help out. As a matter of fact, it sends these bots out there to share this content with somebody that bot thinks looks like you. The other thing is subscribe, and there's a bell right next to it. I do daily market commentaries where I pop in unannounced. Hit that bell because that will give you the heads up that you are, or that I'm going live, and that you will be able to participate in those live events every day when I talk about the markets, talk about the geopolitical, all the economic data and all that stuff. So thank you very much just for checking. Anyway, that The other thing, what was I going to say? Hit the like, smash the subscribe, and everybody's commenting. I will search back around. If you aren't watching this live, I will circle back around for you folks to make sure you guys are all clear of concept. All right. So last thing I've got for you is an offer. If you guys want to take advantage of this, because we are starting a new course here, we're opening this back up to folks. So you guys can all jump on this if you want for $97 a month. One thing to note with this offer, you guys get unlimited access to me. If you ever have a question or want to run by a strategy, run a strategy by me, then I'd be happy to take a look at that, talk about concepts, all of those good things. Like I said, you get unlimited access to that and all of my library of content. All right. So content, that, and unlimited access to our discounts, VIP events and stuff like that. All right. So first 100 people, get on that, take you through this course, and we'll work it out together. Hopefully by the end of it, you'll be a master. That's all I got. Last thing, if you can't take that, take it easy. And thank you. If you have any questions, comments, or anything else, reach out to us at 310-598-6677 or hit us up at trading@protraderstrategies.com. Thanks for joining, everybody, and I appreciate it. I'll see you tomorrow for you folks that are watching the daily market commentaries, spotting the trade. Make sure you hit that bell because you never know when I'm going to pop in. Bye.